we can email out afterwards. Thank you, everyone, for being here. My name is Brittany Quickwarner. I'm the president and CEO of the Eugene Area Chamber of Commerce. This is our Connected to Community webinar series. We kicked these off this last March when the pandemic kind of forced us all to our homes, and there were lots of things going on and lots of questions being asked, and we wanted to do the best we could to get information out to our members and to the broader community about things that were important to them that they needed to know. And we've kept this going throughout the year because we had really great response, and folks were appreciative of the information. And we have been so lucky to have speakers like we have today who have been able to join us to share their expertise. Today's topic, riveting, is about taxes. And there's a lot going on this year. We have local Oregon taxes, and we have the transition of administration will bring some new tax conversations as well. So today we have R.L. Widmer, who is a senior manager at Moss Adams, and Jennifer Young, who's a director at Moss Adams, who are with us to talk a little bit about the Oregon corporate activity tax and some other updates on year-end taxes. So without further ado, I'm going to toss it to them. They have a presentation that they're going to give us, and then we will open it up for questions at the end of the hour.
Thank you, Brittany. I sensed some sarcasm in your voice when you said that it was going to be a riveting presentation. I know that taxes, especially the cat, are not always people's favorite topic, but it is. In our world, it is riveting, so I look forward to it today.
I married an accountant, so I can understand how riveting it is, but I also appreciate that he does our taxes.
That's great. So we do look forward to being with everyone today. We're excited to be here. Let's see, I'll start advancing these slides. Like Brittany said, you got myself. I'm a senior manager with Moss Adams, and then Jennifer Young, who's a director in our state and local practice with us here today. So looking forward to the presentation. So we've got a few things that we're going to be covering today. We're going to be doing some overview of some state taxes and maybe some deadlines that are coming up. We'll spend a little bit of time on that. And then, sorry, I'll kind of shift this over here. We'll be going through the CAT, like was mentioned. We're going to go through some of the proposals from President-elect Joe Biden's campaign tax proposals. And then we'll do some other local tax updates today. So we have some polling questions to kick things off, and I think this one's already launched. It keeps kind of clicking on my screen here. I think maybe I'm supposed to. Is this ready for me to share, Heidi?
Yes, it is. Can you see the sharing results?
I can. So do I hit stop share results?
Yes, if you want to, yes.
Yeah, okay. So it looks like we've got some people that say they've heard of it, and then some people say no clue. So that's good, because that's what we'll be covering, some of that today. So I just stopped sharing and then share results. All right. And then the next polling question, these are just so we can get familiar with who's out there. So Heidi, can you help launch that next poll?
Yes, so it's the second question on the poll. Looks like the majority of everybody said no, they don't know.
Okay, yeah, okay. So I see that on there. I see that on there now. And then let's see here. So then the third poll, should I see that now too? Heidi, the third poll question.
I can actually send it out. I didn't send that one out yet. Would you like me to send out question 3?
Yeah, go ahead and send out question 3. Just again, trying to get the fill of the room here, seeing as we're virtual.
Perfect. Just sent it out.
So this one, we're going to be covering this later. This question may be Greek to some of the folks on the call, and that's okay. We just wanted to get a feel for this up front to see where people are thinking. So it looks like I'll go ahead and.
Can you see the results, RL? We got one person yes, two people saying
Yep.
no. Okay.
Yep. I can see that. So okay, so that's good. So yeah, we'll cover that. We'll cover that here in a little bit, but just wanted to see what people were thinking there. So. All right. Okay. So with that, we're going to go ahead and kick it over to Jennifer for the state tax overview, and then we'll kind of work back and forth with Jennifer and myself.
Okay. Thank you, RL. Well, I wanted to start off with some of the due dates in the Pacific Northwest because we have some new taxes in Oregon, and then also, of course, the pandemic that just threw a monkey wrench into everything. The various states in the Pacific Northwest, just looking at Washington, Oregon, and California, extended to some extent several due dates, but didn't extend others. I don't want to spend too much time on the detail of these slides, but thought it might be a useful resource if you're doing business in multiple states. The takeaway for today is just that some dates have been extended, some have not. The provisions vary from state to state. I will call out Washington, though. If we can advance a slide or two. Or in Oregon, I should call out first, there's wildfire relief. If you are in one of the 8 counties that the state of Oregon has called out as wildfire disaster areas, then you get some automatic penalty and interest relief. So you don't have a deadline extension for estimated payments due in September. You don't have a deadline extension, but there's penalty and interest relief. And if you're in one of those 8 counties, headquartered, or your tax records are located there, or your tax preparer is located there, or you are a business that was providing wildfire relief services for a recognized government or not-for-profit agency, you get automatic relief. If you're not in one of those 8 counties, but you are otherwise impacted by the wildfires, not just in Oregon, but in California, then you can apply for the circumstances beyond your control relief. Again, it doesn't extend any due dates, but it does allow you penalty and most likely interest relief as well. So that's kind of a feature for Oregon. California also has wildfire relief, and theirs is a little more generous. Basically, if you're in a FEMA or California designated area, then you get some automatic relief. Washington has been generous with their COVID relief. If you are a monthly combined excise tax return filer, which includes the Washington B&O return and also sales tax, they've been extending the monthly due dates on kind of a rolling month-to-month basis. And I didn't have the time to update this slide, but basically they've said now that they'll give, for any returns that are due now, just apply for a 1-month extension. And right now that's going through the November returns filed in December. Don't know yet about December returns that will be due in January, but check the Washington Department of Revenue website. It's very clear, and it's a very straightforward process to request an extension of time to pay. The takeaway here is just that the various states have lots of different due dates, lots of different extensions. And so if you're impacted by something, check the specific rules. So rolling on to the Oregon Corporate Activity Tax, or CAT, just a really brief overview. This was effective January 1, 2020. It's a modified gross receipts tax. It's in addition to any other tax or fee imposed in Oregon. It's a straight revenue raiser, not tax reform. It's a permanent tax. It's not a sales tax. It's imposed on the person who has the receipts. And so it's not something that you would typically expect to see on an invoice, but we can talk about passing it through later. The title of the tax is a corporate activity tax. Not quite sure why they chose that specific name, because it applies not just to corporations, but to pretty much any entity with business activities, including individuals. And it applies to unitary groups. Unlike Washington B&O, if you're familiar with that tax, or unlike a sales tax, it applies at a unitary group level, not to a separate legal entity level. And that will become important as we kind of proceed through the analysis. The unitary group concept means that a group of persons, which can include partnerships, S corporations, LLCs, even sole proprietors, if the group has more than 50% common ownership, either direct or indirect, engaged in business activities that constitute a unitary business, that group is one taxpayer for purposes of filing and paying the CAT. If you're familiar with the unitary concept for corporate income tax returns, it applies. There are two very significant differences. The first one is that the common ownership threshold is 80%. And an even bigger, just conceptual difference from my perspective is that for a corporate group, it applies only to corporate entities. But for CAT, it applies to all entities. So a group of partnerships owned by individuals can be one unitary group for the CAT, even though for income tax purposes, each partnership files a separate Oregon tax report and issues its own set of K-1s, and then the individual owners report the K-1 activity to Oregon. The CAT's very different. That group of partnerships, if they meet the 50% common ownership test and they operate in a unitary business so that they're all kind of in the same line of business or have a lot of inter-entity transactions or operate in other respects as something of a unit, then they file one CAT return. And there are still some significant gray areas here and open questions that the Oregon hasn't provided firm guidance on. So one very common ownership pattern can be that, the same three people own 1/3 each of two different partnerships. So no one person owns more than 50%, but the same three individuals own 100%. Is that common ownership? And we don't really have an answer to that yet. I think everyone's been proceeding on the assumption that the 50% really applies to, one individual. So in that case, you wouldn't have common ownership. But it's possible that Oregon could issue a different interpretation. A second big open question here is whether family members would be treated as common owners. So a parent and children, are they treated as one owner or are they treated as separate owners? And it's, again, it's a pretty common structure pattern here where we see one person owning property, maybe even in a single member LLC, and leasing it to a business that's owned by another family member, would that be a unitary group, or would those be two separate entities? Those are both open questions. And here again, I think that most of us have been proceeding on the assumption that family members are not treated as common owners at this point. It would have been pretty easy for the Oregon legislature to include some statutory analysis or statutory language here. They haven't done it, but the direct or indirect language kind of leaves a crack in the door for the Department of Revenue to issue an interpretation that would be a unitary group. So an administrative item here, registration is required within 30 days of earning $750,000 in Oregon sourced receipts, and penalties can apply for a late registration. There's no fee to register. It is done online. The registrant has to have an Oregon online account, but that's pretty much the only hurdle. It's a straightforward, very quick process, no fee. So if you haven't registered at this point, now's a good time to do so. Moving on to the CAT calculation, if you're familiar with the calculation, the calculation itself is really simple. You start with your receipts, your Oregon receipts, subtract exempt receipts, subtract 35% of your cost of goods sold or labor cost times Oregon apportionment, subtract the $1 million exemption, multiply by the rate, and you're done. So the calculation is pretty simple, but the trick is in determining what goes into each line of that calculation. That can be complex and very industry specific. So starting with receipts from sales to Oregon customers, 2 points here. The first one is that if you are a seller of tangible personal property based in Oregon, you might be familiar with the throwback rule that we mentioned at the beginning of the webcast. That is if you make a sale to a customer in another state and you're not taxable in that state, for Oregon income tax, that's thrown back and becomes part of your Oregon numerator for your Oregon income tax apportionment factor. That is not the case for the CAT. So for CAT, you start with only your sales to Oregon customers. If you are not selling tangible personal property, make sure that you review the market sourcing rules. The receipts are based on where your customer is, not based on where you're located, and it can get even more granular than that. So those are important rules to look at in determining your Oregon receipts.
Yeah, Jennifer, I still get a lot of questions too from people, hey, I sold this to someone in Washington or Idaho. Is it subject to CAT? So it's still a question that we get quite a bit. So just keeping in mind that it is just your receipts to sales to Oregon from sales to Oregon customers is an important point.
Yeah, absolutely correct. So then RL, the next issue is your exempt receipts.
Yeah, so you've determined your receipts from sales to Oregon customers. Then kind of the next point on this sort of graph we have here laying out the calculation is exempt receipts. So there's several items of receipts that are exempt. I went to the the Oregon statute that's for CAT. And you go through the list of exempt receipts, and it starts at capital letter A, and it goes all the way through Z, and then it starts over again and goes all the way through capital U. and so there's several exempt items. So make sure as you're looking at your revenue streams that you're looking for, okay, do any of these receipts that I have, or do any of them fall under any of the exemptions? We won't go through every single one of those exemptions today, but there are a couple. Brittany, was there a question that came in, or did you have
a question did just pop up from one of the attendees. They asked how this applies to real estate sales.
Yeah, good question. So if you're selling a real estate, so that's one of the items that are in these exempt receipts, and so the rule in the CAT kind of looks to the Internal Revenue Code or the federal tax law in terms of if you've got something that you're selling that's an asset that's going to be either a capital asset under federal tax law or what's called a 1231 asset, which is essentially an asset that you're using in your trade or business that gets capital gain treatment. So I look at this largely if you're selling something and you're getting some sort of capital gain treatment on that, like you would for most real estate sales, then that is likely to be exempt from the CAT. So good question there. And then, you know, a couple of the other items that are exempt, interest income, dividend income is exempt. Amounts received as an agent, and that's received a lot of questions and a lot of press. So we'll get into that in the next slide, is what qualifies as an agent, or what's the agent exclusion. Retail sales of groceries, wholesale sale of groceries are exempt. For the wholesale sales of grocery, you know, one thing you need to make sure is that you have proper certification received and that the safe harbors are met. There's an administrative rule on that. And then another important one that we wanted to cover was sales made to wholesalers that resell outside of Oregon. So the example there is if you're selling to a wholesaler customer that's here in Oregon, and basically they're just doing some, you know, they're basically just turning around and distributing your product and not really doing any additional manufacturing or anything additional to the product. They're basically just turning around and reselling that outside of Oregon. Then you can receive a certificate from them where they indicate to you the amount of their sales of your product that are going out of state. And to the degree they have sales that are going out of state, then you can exempt those sales from your receipts subject to CAT. So it's important to keep that in mind, and it's important to look at that in terms of when you're determining your Oregon receipts. Jennifer, anything to add there?
No, I don't think so. If you are an agricultural producer located in Oregon, you'll want to look at, it's a amendment to the CAT that was passed in the 1-day special, or the 3-hour special session, called HB 4202, especially with respect to the sales made to wholesalers that resell outside of Oregon, which is a mouthful. We need one phrase for that. There are some if you're an agricultural producer and you sell ag items to wholesalers, there are some really favorable provisions that might reduce your tax and can definitely reduce your paperwork burden. So talk with your tax provider about that.
Yep, that's good to know. And again, keep in mind, we only barely scratched the surface here on the exemptions. So make sure you're looking at those and considering those. Let's see here. So the next one we kind of wanted to maybe spend a little bit more time on is this agent exclusion, because there have been a lot of questions on that. And there is a ruling on the Department of Revenue's website on this exclusion, and basically the way that they define an agent is a person who is acting on behalf or of another and is subject to that other person's control. So that's a key concept here with this agent exclusion, is that you're acting on behalf of another person and you're subject to that person's control. And so they have some examples in the administrative rule that kind of look at a few scenarios. You know, one of the scenarios is a human resource service provider that, you know, provides payroll, human resources, and benefits to a company, and essentially, you know, they're just kind of passing on the payroll to the ultimate employees of the company. And in that case, all the payroll and all the wages and all the benefits are in the control of the company. And so those amounts that they're receiving that are just passed on as payroll are not subject to cap, because it falls under this agent exclusion, and only the fee that HR service provider charges to the company would be subject to cap. So that's one example that's in the ruling, and then the other examples relate specifically to construction, and this is an area where, especially if you're a general contractor, where it's definitely worth taking some time to look at the examples in the administrative rule. The examples are somewhat what I would call textbook examples. You know, they're kind of something you would see in a textbook, and maybe somewhat difficult to apply to real life, but they're still helpful nonetheless to kind of see where the Department of Revenue is thinking on this. And you know, one of the examples that they have is a general contractor that contracts with a company to build a building, and the contractor essentially has it's a fixed price contract. The contractor has complete control over the selection of the subcontractors. They have basically complete control over every step of the project, and there's minimal reporting back to the owner, and the owner of the project retains little control. In that case, the example rules that all of the fee, the entire fixed fee contract that the contractor is receiving from the owner would be subject to CAT, and it would not qualify under this agent exclusion. The other, oh, go ahead.
Sorry, I didn't mean to cut you off there. We did have a follow-up about the real estate question, so yeah, when it makes sense, I'll pop that in.
Okay, perfect. Maybe I'll finish this real quick, and then we can touch on that. So. So the other example in the world of general contractors is if you've got a contract that has a guaranteed maximum price with a fee on top of it, commonly sometimes known as a cost plus contract, and you know, the owner retains a lot of control in selection of the subcontractors. The owner has a lot of retained control over the, you know, some of the management of the contract. Then in that case, you know, a lot of what the contractor is paid could qualify under this agent exclusion, and they would only be subject to CAT on their fee, on the contractor fee that's on top of the main contract. So the main point I wanted to make here is, you know, each of your contracts, if you're a general contractor, or, you know, if you're doing anything where another person has control over how the service is performed, you know, look at the contracts, discuss with your advisors, you know, if those contracts could potentially meet this agent exclusion, and you know, it could be different for each of your contracts. So it's definitely something worth exploring there. Brittany, did we want to hit that follow-up question?
Yeah, so and I think it was maybe just some clarity. So she says, how about sales for realtors? I'm not sure if that differentiation makes sense.
Yeah, so okay, so like a real estate agent.
So Kim says, as a realtor who owns her own company that has 100% ownership and gets paid on commission.
Yeah, I know that there's some stuff in this agent exclusion for real estate agents, and again, I think it kind of really depends on how much, you know, how much control there is of the real estate owners. But I think in most cases, a real estate agent would qualify under this agent exclusion, and then the commission would be what's subject to CAT. Jennifer, I don't know if you've looked into that in a great amount of detail. I have not, so but I do remember reading that, you know, a real estate agent is a potential example there of something that may qualify.
Yeah, certainly. I mean, if you're receiving the total commission, but you need, as the realtor, you own the brokerage and you're receiving the total commissions from all sales, but they don't, a lot of it doesn't belong to you. You're receiving it on behalf of the agent who made the sale. There is a specific, I believe there's a specific exemption in that A through UU list that those would be, you would not be double taxed on that. You'd be taxed, your CAT receipts would be just what you retain as your brokerage fee.
So that might be one too, because again, a lot of these exclusions are somewhat, they're really, as you look into the details, they're really facts and circumstances based. And so it's pretty difficult to give general answers to a lot of the exclusions. So that might be one where we're more than happy to follow up afterwards too, and maybe discuss, you know, a little bit more specifics there. And so Brittany, if you could help us remember that and coordinate that, that's probably one that we can kind of look at afterwards and make sure we've kind of got the right answer there, because again, a lot of these are really heavy on the facts and circumstances.
Yeah, thanks, RL. I can connect you with Kim.
Yeah, perfect. All right, Jennifer, I think we wanted to touch base real quick on use tax component of this.
So this is kind of an odd provision that, but it's something to look out for. And this is if you purchase something as a Oregon business, if you purchase it outside the state and bring it into Oregon within 1 year, that purchase price is to be included as if it's a receipt from a sale to an Oregon customer. You can avoid including it in that top line if it can be documented that the structure was not, or the purchase was not structured to avoid the CAT in whole or in part. And so if you've had an ongoing business process to purchase goods or equipment, software, anything else outside of Oregon, and then bring it into the state, a tangible example would be timber, for instance, purchasing timber in California or Washington or Idaho and bringing it to an Oregon mill. If that's been part of your business process and you haven't structured it that way to avoid the CAT, then you can avoid keeping it in that line 1. But if a purchaser, if you're negotiating with a vendor and they say, I'm going to charge you CAT if I deliver to Oregon, but if you pick it up in Idaho, I won't charge you CAT. That would be something that the Department of Revenue, you know, there'd be a real risk that if they performed an audit, they would see that as CAT avoidance and would issue an assessment to the purchaser for that amount. So the key point here is documentation, documentation, documentation.
All right, so the next step in our journey here of calculating the CAT is the subtraction. And earlier in the presentation, this is where, you know, Jennifer referred to this as a modified gross receipts tax. And the reason that is because it does allow for a subtraction against your gross receipts before you get to your net taxable base. And so this is something that we still see a lot of questions on how to, you know, calculating this subtraction is definitely one of the more complex areas of CAT. And so what you get is you get a subtraction for either 35% of your cost of goods sold or 35% of your labor costs. And you can pick whichever one of those allows for the greater subtraction. Cost of goods sold, the definition that they have in the rules just makes you look right to the Internal Revenue Code. It says, okay, cost of goods sold for purposes of CAT is basically equal to what you would have as cost of goods sold for federal income tax purposes. And so we'll get to that here in a little bit on the next slide. What does that mean? The other option is labor costs. And so where this comes into play and where we get a lot of questions is, well, doesn't my cost of goods sold already include some labor? And indeed it does for those businesses and those industries that are selling goods. a lot of times your labor costs are capitalized into the cost of the goods that you sold. But there are a lot of industries and a lot of businesses, you know, our industry, for example, is as tax accountants and CPAs, where we're selling a service rather than a good. So, you know, one of our highest costs is labor. And so we would look at our labor costs for purposes of calculating the subtraction. So cost of goods sold does include labor. So a lot of times if you're a manufacturer or you're someone that's selling goods, that cost of goods sold number is going to be the higher number for you, because it's going to include labor plus all of your material costs. So that's something to keep in mind there. If you're doing, you know, one of the other complicated things with this subtraction too is if you're doing business both within the state of Oregon and outside the state of Oregon, there are some rules that you need to follow to basically take your cost of goods sold or your labor costs and allocate that or apportion that between your Oregon business and your out-of-state Oregon business. And there's been some back and forth on this all year long, but it appears where we've landed is that you've got a couple of options in terms of apportioning that your cost of goods sold, and one option is using your income tax apportionment percentage from your Oregon income tax return. And this is something that could, you know, result in a pretty large benefit for especially in-state Oregon businesses, because if we go back to those throwback sales that Jennifer was talking about earlier, you know, if you're making sales to a state that you're not taxable in, and you're throwing back those sales for income tax purposes, then that's going to increase your Oregon income tax apportionment percentage. So you're going to have a higher income tax apportionment for those throwback sales, which then would in turn increase this cost of goods sold subtraction. But remember, you're not including those throwback sales for your receipts for cap purposes. So it does, you know, it does kind of create a situation where, you know, in-state Oregon taxpayers, you know, this is something that would only be, you know, that would only benefit them and put them maybe in a little bit of a beneficial position as compared to out-of-state Oregon taxpayers. So it's an interesting rule there that may end up with some challenge. The other option is you could prorate your cost of goods sold or your labor costs by just looking at, okay, what are my CAT receipts versus what are my out-of-state non-CAT receipts, and you can use that ratio or that proration as well. So you can look at either one and see what is, you know, what results in the higher benefit there. So moving on to cost of goods sold, this is an important sort of piece to look at as you're planning for year end and as you're doing the CAT calculation. Again, the rules for the CAT point you towards the, you know, how you calculate cost of goods sold under the federal income tax code. And the Internal Revenue Code is not necessarily cut and dry where you can just search the Internal Revenue Code for the definition of cost of goods sold. It's not really there. It's spread over many code sections, and there's a lot of definitions there. And but generally speaking, you know, the thing that's really clear and obvious is, you know, as you're selling goods, you know, the direct expenses such as your material purchases and your direct labor, those have, you know, of course, are included in cost of goods. But there's also rules in the federal tax code that require you to, you know, allocate some of your indirect expenses, some of your general and administrative expenses, and indirect labor to your goods being sold. You know, those are commonly known as additional 263 Cap A costs, or you might hear it called as UNICAP, are two different ways that those can be looked at. And so there's a potential there that there's a lot of indirect expenses that maybe you didn't really, you know, either you weren't really subject to those UNICAP rules or you didn't look at it very closely in the past. But knowing that now some of those may be able to be included in your cost of goods sold, it's a really good time to look at how you're classifying your costs and making sure that you're maximizing your benefit both from a federal tax perspective and a CAT perspective in terms of how you're classifying your cost of goods sold. So that's definitely something to look at. One thing to be careful of, we've seen it in the past, you know, sometimes we'll see taxpayers that are more in a service line industry. Trucking and logistics is a good example. Hotels, you know, the hospitality world might be another good example where you're not really selling a good, and so sometimes classifying your costs as cost of goods sold isn't really going to fly under the federal income tax rules. And so just because you call it cost of goods sold on a tax return doesn't necessarily make it cost of goods sold, and something that could potentially be challenged if Oregon were to look at your CAT calculation. So the point there, without getting into too much detail, is just make sure you understand and work with your advisors on what can be included in cost of goods sold and what shouldn't be. And if you're in a business that's primarily selling services, you're probably looking primarily at that labor cost item for your subtraction. So that brings us to our polling question. So Heidi, if you could launch that. Just wondering how many people have looked at cost classification to make sure you've captured everything that you can as cost of goods sold. We'll give people a few minutes to respond there. It looks like so far the majority of people are saying no. And so that's, you know, as we look, there's a slide we have here and a couple of slides talking about things to do before year end or potential action items, and definitely one of those is so yeah, majority, 83% of the folks here that responded to the poll said no. So so yeah, that's definitely something that is something that taxpayers should be looking at as we approach year end, especially before we get to, you know, the actual filing of the CAT return, which kind of brings us to our next slide, walking through the cadence of how this is going to work. You know, those of you that have been working through this throughout the year know that the quarterly estimates have been due through October 31st. We have Q4 coming up January 31st. For 2020, they said if you expected to have less than $10,000 in total CAT for the year, then you weren't subject to estimated payments. Going forward, that's just going to be $5,000. So you could be in a situation where you didn't have to make estimated payments this year, but you may have to next year. And then the important piece here is that the CAT return is due April 15th, 2021. And this will work similar to how it does, you know, for income tax purposes, where you'll file your return, you'll make your final calculation on what your CAT is, and then you'll true that up with your estimated payments that you've made. And you may have overpaid and you may have underpaid. So if you've overpaid, you know, you'll be able to claim a refund or apply that to next year. And if you've underpaid, there'll be an amount due with that April 15th CAT return. So running a little bit of short on time here, so try to speed things up a little bit. Some things that, you know, for purposes of looking at year end, again, we've already discussed this, you know, looking at your cost of goods sold to make sure that you have a benefit, there. And then make sure you're obtaining certificates from your wholesale customers. We discussed that earlier as a potential exemption. And then just making sure that you're analyzing all your revenue streams for potential exemptions from CAT. So those are definitely some important things to add there. Jennifer, I don't know if you have anything to add there.
No, I think that's a good year-end recap to start scrubbing those types of records. And if we can move forward. I think we lost RL for, oh, here we go.
Yeah, sorry about that.
Okay.
the joys of doing Zoom webinars from home, right? You never know what's going to come up. Our robot vacuum turned on for some random reason, so sorry about that. Sorry about that background noise there. So, all right. So the next thing we kind of wanted to discuss, kind of transitioning away from CAT a little bit, but this does impact CAT, is a quick update on PPP loans. And I know a lot of people in the community, a lot of businesses here in Eugene and everywhere across the state obtained the Paycheck Protection Program loans from the federal government. We're not going to get into a lot of detail on these because I think a lot of people are pretty familiar with them and we just don't have the time. But a couple quick updates, recent rulings from the IRS on the tax impacts of forgiveness of PPP loans. And so back in May, the IRS issued a notice, I guess even beginning back a little bit further, when the CARES Act initially authorized the PPP loans back in March. When Congress wrote these rules, they said, okay, any loan forgiveness that a taxpayer obtains from a PPP loan, any loan that's forgiven will be exempt from taxable income. So everyone felt like, oh, that's pretty cool. You know, you can get a loan forgiveness on this and not have it be subject to tax. Well, the IRS, the ultimate Debbie Downer, came in May and said, well, hold on a second. The forgiveness may be exempt from taxable income, but what that means is if you paid for expenses like you'd have to, your payroll expenses and all of the costs that you included in your application for forgiveness, all of those expenses, to the degree they result in forgiveness of a PPP loan, are going to be non-deductible. And so essentially what that did is it basically made the PPP loan forgiveness taxable, which Congress has said to the IRS many times over the year that was counter congressional intent. Well, the IRS recently, a couple weeks ago, doubled down on that and said, because there were a lot of questions about, well, when are the expenses non-deductible? Are they non-deductible in the year that they were incurred, or are they non-deductible in the year that we actually receive forgiveness? And the IRS came out a couple of weeks ago and said, and doubled down on this and said, okay, if you, taxpayer, had expenses in 2020 that you expect to receive loan forgiveness related to, then even if you don't receive forgiveness or you're not officially approved for forgiveness until 2021, if you reasonably expect to be forgiven, then those expenses are non-deductible in 2020. And so that's created quite the, planning difficulty or uncertainty for some people, especially some people that are really banking on those expenses being deductible. But now we've got this IRS ruling that's doubled down and essentially said that, you need to be planning for those expenses to be non-deductible. So when you're looking at your year-end tax projections, keep that in mind, that those expenses may result in some non-deductible expenses, which would increase your taxable income. And that may have impacts to the CAT subtraction, because what we just discussed, related to cost of goods sold and labor costs, potentially labor costs, but definitely seems cost of goods sold, that if you're not able to deduct those under the Internal Revenue Code, then you're likely not able to include them as part of your cost of goods sold subtraction for CAT. Labor costs have a different definition and aren't necessarily tied to the Internal Revenue Code. So if you're using labor costs for your subtraction, there may be some potential there that you could still include it, even if it's non-deductible, but more to come there for sure. And this may have an impact to other credit calculations. If you're a taxpayer that's utilizing the R&D credit, there's still some uncertainty of, okay, if these payroll expenses are non-deductible, then does that mean that they're not included in as potential wages for the R&D credit or other credits that you may be calculating as a business? So Again, the IRS has pretty much put their foot down on this and doubled down on it, so it's something to watch for. After the IRS issued that, both Senator Wyden and Senator Grassley said that they were, you know, that they felt that this was not, that they felt like this was counter to congressional intent, and that they asked the IRS to reverse course, but I don't think the IRS will. I think the IRS is maybe forcing Congress's hand a little bit here and saying you guys need to do something legislatively to fix this. So there's been some discussion of maybe some fix being included in the funding bill, or maybe a round 4 of CARES stimulation package. So at this point, plan on those expenses being non-deductible unless you see something from Congress to fix it. So that's what I had on PPP. So real quick, just wanted to go through some of the proposals from President-elect Joe Biden. And so there's several things in here. We're not going to go through all of them for sure. I don't have the time to do that, but wanted to have them in the slides anyway, so you could go back and reference some of these. Again, keep in mind these are largely campaign promises and stuff that came out during the campaign. There's a lot still to happen to determine whether or not any of this will actually become law or not. But wanted to make sure people were aware of some of the things that were said during the campaign and some of the proposals that were put out there. I think the Georgia Senate runoff races will have a big determining factor in if any of this actually becomes law. If the Republicans retain control of the Senate, it's doubtful that a lot of this would make it through. But so something to keep an eye on there. So a few of the highlights that I wanted to hit on here with some of the proposals that Joe Biden made during the campaign. The top one being the increase in the corporate tax rate. So right now, the current law is a flat 21% for all corporations, and he has proposed raising that to 28%. So if you're operating, again, that's C corporations, not pass-through entities. And so if you're operating and taxed as a C corporation, that's something for you to keep your eye on. For pass-through entities, the last couple of years, we've had this thing called the qualified business income deduction. That's been a way to lower the tax rate for taxpayers that are partners or shareholders in partnerships and S corps, and also sole proprietors. And so that's been a nice deduction, and Joe Biden has proposed phasing that out for taxpayers earning more than $400,000. I think you'll see a pretty common theme throughout these slides on Joe Biden's proposals, regarding a lot of his proposals are phase in at taxpayers with more than $400,000 of income, and I think we heard that in the debates some, and so you'll see that throughout here. Kind of skip through these. Real quick on the real estate item on this slide, one thing that he has mentioned is removing like-kind exchanges. 1031 exchanges. Who knows if that would ever gain any traction? It seems like that would take a lot to remove that. That's been in the tax code since the tax code was enacted in the 1920s. So that's been around for a long time. And so it'll be interesting to see if there's any movement on that. Skip through some of that. Couple of key things here. He has proposed raising the top tax rate to 39.6%, which is currently 37%, to taxpayers with income over 400,000. A big item for a lot of our clients and probably a lot of you that's been on a lot of people's mind is the capital gain rate. Joe Biden has proposed removing the preferential rate for taxpayers with income of over $1 million. So that could be a big difference. So, if you're planning on paying capital gains at 20% and then that kicks in and you're over $1 million, then all of a sudden your tax rate is 39.6%. if both of those proposals go through. So that would be a big difference, and a lot different from what we're used to. There's been some proposals on estate tax. So, you know, right now is a great time to look at estate tax planning and gift planning if that applies. Kind of skip through some of these. Again, a lot of these are here for reference, so I'll kind of move through those now. So I know we don't have much time left, but we did have a polling question. Jennifer, I don't know if we still want to try to cover this or if we just want to go to questions, see what's out there.
I think I can. I know we're coming right up at the top of the hour, so if you do business in the Portland or Multnomah metropolitan area, even if you're not in Portland or Multnomah County itself, there are some new taxes that are effective, really short fuse. They're effective with it next month, January 1, 2021. The Multnomah County business income tax rate increased. It's 2% now. That's effective for 2020. There's a new metro tax on businesses that do business in the Tri-County metro area. So it's Multnomah, Clackamas, and Washington counties. If you do business in one of those counties, check the metro area boundaries. If you do business within that boundary, there's a new 1% tax on net income. And on individuals who have either live in that area or have income from sources within that area. And one of income from sources within that area is a non-resident who works for a company that's in the metro district. That just came out the other day. And that's effective January 1. We also have a new Multnomah County individual income tax. Oh, just to back up, the metro area tax is for supportive housing services and is often termed the homeless tax. So that's that tax, if you've heard of it. There's also a new Multnomah County tax. This is to fund preschool, and that is on individuals only. So individuals who live in Multnomah County or have income from sources in Multnomah County, that's 1.5% on income over $125,000 for individuals or $200,000 for couples. The rate bumps up to 3% for income over $250,000 or $400,000. And those rates, this has not been quite as widely reported. In 5 years, those rates bump up to 2.3% and 3.8%. That's in the statute itself. Just wanted to mention those really quickly. I think that we've got slides in here as reference, but that's a good overview. And so I think that brings us to kind of the top of the hour. If there are any questions, we'd be happy to address them now, or if you want to send them to your chamber rep, we can address them later individually as well.
Thank you guys so much. Don't have any questions in the chat just now, but if anybody has them, please feel free to pop those in. For those who are watching this webinar recorded after the session, please feel free to shoot questions over to the chamber and we can get those over to RL and Jennifer, and happy to try and connect you guys in case you would like some specific advice. So we really appreciate you guys joining us. RL, Jennifer, this was really informative, and I appreciate how much time you put into putting this presentation together and helping out our members. Thank you.
Yeah, our pleasure. It was great to join the chamber for this, and appreciate all the work the chamber does.
Yeah, thank you.
Just a reminder that all of these webinar recordings will be on our website, on our Connected to Community webinar page. And if you signed up for the program, we'll send you a copy of the recording as well, so you can go back and reference this. Thanks everybody so much for joining us. A big shout out and thank you to the sponsors here on my side. These are our annual sponsors throughout the year, and they have helped make everything that we've been able to do this year possible. So a huge shout out to those, including Moss Adams. Thank you guys so much.
Thank you.
Thank you.
All right,
Bye, everyone.
Have a good one.
Bye.